tried to picture clusters of information as they moved through the computer. What did they look like? Ships, motorcycles? Were the circuits like freeways? I kept dreaming of a world I thought I'd never see. And then, one day...
You got in.
That's right, man. I got in.
The introduction of Fintech. The purpose of this chapter is to include broad image of this fractured universe. It begins with the history of Fintech ventures, dealing with the numerous waves that have marked their path. This chapter offers some insight into the entire financial services market, describing the impediments under which Fintech companies exploit to disintermediate conventional financial organizations. Finally, from a worldwide viewpoint, this chapter presents an overview of the most important fintech regions and ecosystems, presenting the future innovations and development of the entire industry.
Changing environment. There have been major shifts in the banking and finance sectors over the last few years. The reasons are several, such as the effects of the financial and economic crisis of 2008, the increasing regulation of incumbent players, and the social and behavioral changes in the customers. In the last few years, digital transformation has been the primary catalyst of the fintech phenomenon. The financial crisis, regulation, and trust. Many customers, and especially the so-called millennials, had lost faith in the traditional financial services. Old and new generations of customers are willing to turn their backs on the traditional players. They are keen to see new companies emerge that played no part in the recent crisis and could offer innovative solutions to financial services. From customers to users of financial services, customers are active today. They expect to receive solutions tailored to their personal needs. Matching products and services to the expectations of the user requires close mass interaction. Fintech companies target younger generations using digital, interactive, customized solutions. On average, younger generations have fewer assets than the rest of the population. Fintech ventures will continue to fail to draw successful clients. They will help to adapt to deliver the same interaction and profitability as their fintech rivals. This is the only way that business giants can survive the transition from customers to users. Financial services, problems and challenges. European financial services have accumulated very large losses in the last decades. The Italian government is working on plans to set up 50 billion bad bank bailout. From the spread crisis of 2011, the overall Italian universe of banks has produced nearly 50 billion of net losses. The Royal of Scotland, since the beginning of the crisis, has accumulated 48 billion of losses. Deutsche Bank, for instance, suffered a heavy and continuous contraction of the profitability. Bankruptcy problems are caused by losses, and losses are caused by financial problems. Stability in the financial services sector is essential for the smooth functioning of the economy. Bad financial services high global crisis, while good financial services low global crisis. Regulators have moved toward a new direction, new solvency regulation, upgraded capital regulation, and focus on structural reforms in the financial services. Without the support, the amount of losses incurred by financial institutions is high, and the economy is having a profound critical impact. New challenges are more and more appearing. The continuously increasing relevance of fintech initiatives and new stability-focused regulation. Therefore, traditional services are taking drastic measures. Cost-cutting policies are the traditional countermeasures to fight the reduction in the levels of profitability.
Customer centricity. The business model is the one of the key explanation for the enormous quantity of traditional financial services institutions that have incurred losses. This company also have outdated business models that are not up to date, built for old-style markets and clients that have changed their needs in the meantime. The key goals of the achieving sustainable growth and an above-average level of profitability by embarking on a customer-centered transition is also likely to be overshadowed by the process, and it is important to listen to the customer's voice. Digital transformations. Moving toward a digital transformation is one important way to address today's challenges. A laggard in this regard is the financial services market. In this case, the ability to process a series of repetitive tasks of the rate previously unknown in trading is the most significant features of the digital transformations. The high cost of consistently implementing this method has, for a long time, discouraged their widespread use. Information acquisitions and retrieval were not widely available. They were constantly raising the entry barrier for new players. There is the first digital transitions and the second phase of the digital transformations.
Definition of Fintech. The word Fintech comes from a combination of two complementary areas, financial service and solution based on advanced technology. Fintech has used the Oxford Dictionary as computer program and other technology used to support or activate banking. Wikipedia also defines Fintech as financial technology is a line of business using software to provide financial service. The simple definition of Fintech is an industry consisting organization that use new financial technology for support or service delivery. History and stage of Fintech. Fintech 1.0 introduction of the telegraph on 1838 and later with the successful construction of the first transatlantic cable in 1866. This cable allowed globalization from 1866 to 1913. 5 years later, in 1918, an electronic money transfer system called as freight wire emerged. In the 1950 years, there was a major change in money transfer with the advent of credit cards. Fintech 2.0. The first ATM machine were introduced on 1967. This actually allowed people to conduct financial transactions through electronic telecommunication device. ATM is one of the early applications of technology to finance, which allow important economic savings to financial institutions by introducing automation rather than one's workforce in the relationship between customer and financial institution. E-commerce began to appear in the 1990s. In addition, many internet banking services and online stock selling websites have emerged. This era stopped when the economic crisis occurred in 2008. Fintech 3.0. Since the economic crisis in 2008, many people do not trust traditional banking. This gap has been used by many people to start financial service. In 2009, Satoshi Nakamoto introduced a new type of money called as Bitcoin. This is a form of digital currency to conduct transactions without the involvement of the central bank. This was also driven by the advent of smartphones that enabled the use of mobile banking in the early 2000s. In the era of Industry 4.0, information system and data exchange become better until there were some change in economic trends. Current payment and deposit system not only operated by banks but also fintech companies. Fintech 4.0, where fintech has grown by facilitating the financial system and is felt to be a threat to the conventional banking world. Along with the progress of fintech companies, they will fall closer tied with the traditional finance. Inter-system interfaces are a common source of cyber vulnerabilities. To avoid this, the relationship between digital financial systems should be carefully scrutinized.
An overview of fintech initiatives around the world. The fintech market has undergone growth in investments and business size from a growth of the overall conditions on fintech initiatives standpoint. The connection between these two features will bring benefits to one another. If the bank and financial institute invest more in the high-level technology, so the business size will expand. In 2015, it has been stated by venture scanner that the funding amount of $33 billion obtained from 1,379 fintech companies. This shows a rapid growth from the total funding collected than the previous year, and it has been clarified that fintech is a popular way that measures growth in investment revenue and employment through the process of its growth of phase life cycle. In addition, the learning of the structure of a fintech ecosystem, beginning from the subsystems related to the stakeholders and connected to the 5 core ecosystem characteristics. The business ecosystem is a connection of organizations, including in the distribution of a definite product or services through opposition and supporters involving competitors, suppliers, customers, and so on. Ernst & Young identified 5 core ecosystem attributes, which are demand, talent, capital, policy, and solutions. Each of these attributes help fintech organizations allocate their profit by the viability of the channels that connect the various parts of the entire ecosystem.
EY and CB Insight have analyzed several regions from a fintech field angel. Each area shows various patterns of different in some angles, such as set markets and investment. In the UK in 2014, Project Innovate is one example of a simple regulatory framework that accelerates growth without the needs for large capital expenditures. In addition, in terms of tax initiative, the UK leads and is followed by Singapore. On the other hand, the US benefits from large capital accumulation funds in fintech investment. Based on analysis in 2014, Accenture predicts that the US will reach $4.7 billion annually asset in 2018. In December 2015, $7.30 billion was invested only in New York and Florida. The UK actually balanced the 5 properties mentioned earlier. At the same time, this ecosystem can optimize the relationship between all stakeholders with strong policy management and innovative government initiatives. The countries of New York and California can maximize their power. In addition, Asia Pacific is systematically gaining traction, attracting large amounts of capital due to being the large non-banking population in the world, having a strong private wealth market, and the economy is still growing rapidly.
Downside of disruptive fintech initiative. Despite the advantage of fintech projects, there is a certain amount of a host of future problems. Sometimes, regardless of the context in which they are used, disruptive innovative have certain downside. The works make the possible downside even greater in the case of fintech initiative. There is new risk exposed with fintech initiative. One of them is financial services and industries vendors consider themselves fraudulent. When technology evolves, so do the skills and resources of hackers. The essence of attackers has changed. They are extremely coordinated. They may also be nation-states. In some instances, the industry has significant risks. Fintech programs may suffer from the risks associated with them.
The gap between traditional institutions and fintech companies is wide, since the financial services industry has been encountering a radical change. A company that runs in the financial services industry are also included in the fintech. The disruptive force of fintech in the financial services system includes unbundling, meaning they provide various lines of business products to create a better performing company and fulfill customers' financial services needs. Furthermore, fintech startups can create better innovative products and services than their opponents. Besides, fintech enhances customers' experience better than traditional financial organizations, and they provide advantages in customer acquisition and retention.
Next, offer better prices. For example, fintech leverage increasing customer sophistication and declining confidence in large financial service providers, making their offers more attractive. In addition, target less served markets. For example, many fintech companies hope to not only build businesses that serve the untapped market, but also to leverage it as a foothold for later expansions into other markets or upgrades to their initial markets. Lastly, using innovative solutions. An example is, thanks to the use of advanced technology and sleek process, fintech companies are able to provide very attractive service to different market segments.